Hey traders, welcome to Charts and Coffee. Hope everyone is doing great. Yes, the markets, well, not all the markets, but yes, equities are closed today. No ETF trading, no stock option trading, but futures are open. Futures are open. Forex is open as well. And it's just a habit, Monday through Friday, I'm a trader. Doesn't matter if there's a holiday, there's always a chart that's asking me to take a look at it. So that is what a day like today, at least the morning, is all about. Before we dive into the charts and your questions, of course, feel free to type them in. We'll go ahead and tackle them here today. A couple things to kick off the morning first, and that is make sure you're in sync with the economic calendar. Make sure that aside from the bank holiday in the US today and in Canada today, ask yourself what's happening today that once we open tomorrow, meaning the US opens tomorrow, they're going to see what happened the previous session and say, hey, what do we need to realign to? Because clearly the markets were open. What was happening on the bank holiday? Other than, a little bit of services PMI and the the Reserve Bank of Australia rate statement, which really is not going to be a big factor for the US. We're going to go into Tuesday really with 10 a.m. in mind with the ISM services PMI, and then going into Wednesday, FOMC speak. We've got 3 different speakers on Wednesday, as you can see. Then Thursday, this is the day that, Tuesday, pretty quiet. Wednesday, kind of a prep for the opening act, if you will, for Fed Chair Powell. And then boom, we have Powell and the second most important central bank in terms of global G7, G8, FOMC, ECB. We have ECB on Thursday. So that's going to be another big one to keep an eye on. And ultimately, what we want to remember with any of these central bank discussions is every central bank is in their own timeline, in their own cycle for rate hikes for the most part. So the Bank of England went first, if you will. They've already started their tightening cycle. The ECB is kind of on the early stage of their tightening cycle. The US is on the latter stage of the tightening cycle. So this isn't going to echo across all monetary policy messaging, but rather, what does the ECB have to say about their economy, where their rates are? And heads up, if it's going to move the euro, it's 100% in a negative correlation going to move the US dollar. These are things that I keep in mind. Keeps me out of trouble when it comes to other central banks and their effect on the US dollar. All right, so let's go ahead and, let's go ahead and segue over to the questions. I see them streaming in. All right, Dale. Hey there. Good morning, Dale. Been trading about a year now. That's awesome, Dale. Dale, it's my job. It's my pleasure. And Dale, I'll tell you what, straight up, it's self-serving. We all figure out what it is, that thing that we love to do is. I love to learn. And one of the best ways to learn is to teach. Go figure. And in the teaching and in the questions you all ask me, I've got to fine-tune my process, and I've got to fine-tune my approach to better show you what I do, what I've done and what I do. And, I realize some of you, this might be your very first Charts and Coffee. And, hi, I'm Raghee. And, what I'm trying to, and welcome to my office, by the way. And what I'm trying to convey is, 30 years of trading, everything from Forex to futures to stocks to ETFs to options to crypto, never having blown up an account, prioritizing risk, and then pointing out those pitfalls that I had to deal with so that you don't. If I can point out and say, hey, there's going to be a little pothole along the way, and I can point it out for you. I mean, that's why I do what I do. And in that way, you all have a much smoother, hopefully quicker, hopefully better learning curve than I did, right? So I appreciate that, Dale. That's super nice of you. What do I think about Ford? All right. So aside from a little bit of bias, I'm a Ford girl. Love my Mustangs. So aside from that, what do I think of Ford? It's back in the early part of August. If you can take a look, what I'll do, and this is what I'm always going to do, prioritize, structure, then strategy, then secret squiggles. Those are our 3 S's. That's my process. And so what I know is that we had an uptrend based on what we see, and now we're trying to segue a little bit out of it, but it seems to be we're still above the 200 exponential. That's the bullish hemisphere. And what I would focus on is pullback buys. That's what I think about Ford. Yeah, that's what I would continue to focus on. Do I think the release of Beige Book is important to the macro calendar? I think that it used to have a whole lot more importance than it does say now. I don't know that it's really just, what is the Beige Book? It's literally a beige colored book. And it's basically the summary of what's happening now in the economy. And the Federal Reserve puts this out, I think, 8 times a year. And it's usually published. So think about the timing. You say, wait a minute, 8 times a year. Aren't there 8 FOMC meetings every year? So these are typically put out, published, released in front of an FOMC meeting. So you get this kind of little book about where I think it's called the current economic conditions, and it just happens to be a beige color. Do I think it's an important macro? It's a sneak preview, right? It's a sneak preview of what we might anticipate the Federal Reserve is going to say in the meeting that it's a precursor for. So it's hard to say that that's always going to echo what the Federal Reserve is going to communicate. This is going to be on the 16th, but it's certainly something to take a look at. I mean, what was the reaction to it? And then, you can Google Beige Book after the release and just kind of see what the general interpretation and reaction to it was. It's hard to treat it. And I love the question. It's hard to treat it as a macro in that, how do I use it on a rate of change? Is it a data release? Is it, it's kind of difficult because it's a little bit more about communication than it is a hard number that I can say, okay, this is the trajectory of the previous numbers, and this is where the current one falls in line with that. Definitely something to watch. Harder to look at from a rate of change basis. More about maybe a sneak peek at what's going to come in the next meeting. So thanks for the question. Good stuff. Good stuff. All right. Next up is, what are my thoughts? Hey there, Mark. How are you? What are my thoughts on Disney? So not that dissimilar to Ford. It's been moving higher. Green, not heading higher for as long as Ford was, but clearly we have a double green structure, 8, 13, 21, 34 EMA moving higher. That's where I'll say, hey, I've got an uptrend. I'd like to buy the dip. The dip happened. And in that process, we can now see that it's gone a little bit more neutral. A pullback of an uptrend is not a downtrend, but rather a retracement or a regression from the mean. And we know that outliers tend to what? They tend to regress to the mean. This is my mean, the 34 EMA wave. It's hard to call it bearish. It's not necessarily valid to call it an uptrend anymore. So it's really bullish chop. It's really bullish chop. So I would say the closer we get to an oversold stochastic, and we're not that far from it, the closer the slow stow can get to that low level, which is the 20 level on a slow stochastic, which is oversold, the more content I'm going to be about maybe the rally. But from this area here, perfectly buyable. Yeah, the slow stow says we're very likely to move higher once it gets off that oversold level. Yeah, I like it. I like it. To the long side, Mark, I'm with you. I think we're looking at the same thing. Yellow structure, but double green preceded it. Yeah, I'm with you. I'm with you. All right. Next up is, let's see there. Hey there, Dustin. NEE. Sure. Let's take a look. Oh, and by the way, Dustin brings up a good point. Mark, XLC. Let's just, oops, where'd I go? There we go. XLC. Here we go. Keep an eye on XLC and then ask yourself, is Diz a leading name within the communications? Is it still a relative outperformer? So Dustin, yep, I love the way you phrase this question. NEE, am I looking at this or any other XLU plays as it goes neutral? NEE, for all intents and purposes, sort of is the XLU because of its weighting. However, we know that, let's crack open the XLU here. What do we know about XLU? Okay, take a peek. NEE, DUK, SRE, which I do not believe. Let me take a look at the option chain on SRE here for a moment. I do not believe SRE is all that liquid, but let me check because I really don't remember. Oh, no, it's not terrible. It's not terrible. 165 calls, have 296 open interest. That's a little tricky. The 170s, which are out of the money and not really what I want, have 708. Yeah, so that's going to be a little illiquid for us. However, any of the double greens, Dustin, that don't have a red, where are my drawing tools here? Let me pull these up. All right. Any of the double greens in XLU, right, with liquidity are going to be preferable. Any of the yellows that do not have a red Momo, so eliminate the ones with the red momentum trade flags, any of the double yellows that do not have a red grab candle. So NEE, I'd have to say I'd have to cut that one, right? And that would leave me with any of the remaining pullbacks that are still double green or only have blue grab candles. So I'd have to say Southern is near the top of my list. I'd have to say, take a look at WEC, ED, XEL, but I think I like, yeah, SO. Dustin, I would, so that's how I scan. I would say SO. Take a look here at SO. It's above the 200. No blue grab candles. Good support at the wave. I mean, that's the process right there. So I love that you're looking at XLU, defensive corner of the market. Good stuff. I would say SO. Dustin, yeah, that's what I would focus on there. Cool. All right, next up is thoughts on ENPH. Sure. Let's take a peek. Be nice if I typed it in right. Who says you have to be able to type to be a trader? You all know I'm going to die on a hill of typos. All right. So anyone's in the room who has watched me put out my daily newsletter, my daily notes, you know my typing is awful. So you don't have to be a good typing person to be a trader. All right. ENPH. So the question on ENPH is, sorry, Alex, I skipped over your question. All right, give me one moment. I did not realize the futures market was open today. Yes. Am I correct in assuming that it will be, that with equity flows, it will be low volume, narrow range? I don't know about the narrow range, Alex, but it will be lower volume, lower participation. It may not necessarily be lower range, though. But so far, it has been relatively low range. But yeah, that's a really good assumption. And then we'll take a look at the movement after that. But remember, the Asian session was open, European session, UK. So the drop off in volume and turnover after noon Eastern is going to be dramatic. So if there is on a bank holiday in the US a window to trade, it's really not going to go much further past 11 or noon Eastern. So yeah, great question. All right, so back to ENPH. Let's see. I like the double green, a little bit of yellow, nearly oversold. I don't have a problem with this one. So what we'd want to do then, so when I say I don't have a problem with it, what I mean is based on what I see and based on what you all can see too, the trend was very well established before now. So what I've found over the years is most traders do better when they're dealing with uptrends or bullish markets. This is definitely a bullish market. Go out to October 21, pretty decent liquidity. If you're going to take a look at, say, the 270, ouch. So this is still spotty. Wow. This is still pretty spotty on the options chain. Wow, it's low for some. So ENPH is cool, Jim. The problem is when you crack open the option chain and you look at those options that we would want to get long in, not a whole heck of a lot there. Yeah, not a whole heck of a lot there. Now it could change, but right now the strikes that I would want are just double-digit open interests. So keep an eye on the liquidity. Could be something to keep an eye on. All right, next up. Hey there, Raphael. If commodities and US dollars go up, the stocks are going down. What's my opinion? If commodities and US dollar go up, stocks go down. I don't lock. I try not to lock. There's two things that I try not to do, and it served me really well. So see how much of this works and resonates with you, Raphael. I don't believe there's anything that leads the market. So I don't think there's a consistent symbol or market internal or anything like that that leads market behavior. As if to say, look, leading is when I take my dog for a walk, give or take, where I'm going is where my dog's going, right? I don't know that there's that kind of relationship in the market. So I don't subscribe to that. And the other part is, I don't know that I don't know that I've experienced a prolonged period of time in my career where US dollar is absolutely negatively or inversely correlated to equities. Yes, certain stocks are not going to be happy when dollar is strong. And oftentimes strong dollar does coordinate with a tightening policy that stocks don't like. But rather than saying dollar and equities are inversely correlated, what I'll say is, what's the monetary policy that triggers a strong dollar? It's usually going to be monetary policy that equities won't like. So rather than saying they're attached, I'll say that, look, they're reacting to a similar catalyst. Does that make sense? And sometimes you will see an inverse correlation. Right now, hang on, do I have this up? Give me one moment, and I have a spreadsheet that I usually keep. Let's see where we are. To look at dollar and say S&P and what their current intermarket correlation is. So S&P and let's see, euro. Right now, I have them in about a negative 40% correlation. So negative means they're inversely correlated. When one's going up, the other is going down, 40%. To have a correlation that's really helpful, it should really be north of 70. And then you want to see it north of 70 kind of all the time. I'll give you another correlation with the dollar. Bonds are at a negative 85. Notes are at a negative 90. Let's see. And I'm trying to find where the euro is going to always have a really high. The euro. Yeah, here's your euro. Euro has a negative 98% correlation, almost 100%, which is to say if the dollar goes up, euro goes down. And that is unbelievably consistent. Right now, the strength of the dollar has the negative correlation with the euro, the yen, the Canadian dollar, and the pound in the high 90s. Why is that? Because when we look at Forex pairs, strong dollar accelerating against a weaker currency is going to create a little bit more of that inverse correlation, that contrast. So unless I can look at my little spreadsheet here and see that over time that's pretty steady, I'll say more likely they share a common catalyst than they do a relationship against each other. Does that make sense? I hope that makes sense. Euro and US dollar absolutely have a relationship against each other because the largest market on the planet, bar none, by a landslide, is the euro versus US dollar pair. That's the biggest market in the biggest market. That Forex pair within the foreign exchange is the biggest relationship. And that's where that very strong negative correlation comes from. So great question, Raphael. That's the way I look at it. And that's what served me throughout my career. Hey there, Darius. Good morning. I mentioned that I've never blown up an account. Never have. Nope. And by the way, I'm so glad you asked. Blowing up an account is not zero. Blowing up an account is exceeding 50%. So risk of ruin, I should say risk of ruin. Like, yes, by what we define as traders, blowing up an account is pretty much driving it to zero. Blew up my account, right? You no longer trade out of it. Whether it's 10% or 20%, you don't have the required capital to show up the next day and trade. Risk of ruin is 50%. At 50%, we've got to pause, stop. Something's wrong. So if we can sort of put airbags on our account, that's 50%. Seatbelts, if you will, that's about 25% drawdown of the account. So no, I've never blown up an account. What was your starting capital when I first began trading? Darius, when I first started trading, my father was a lifelong IBMer. So I had a lot of shares of IBM that he had left us. My father passed when I was right after my 15th birthday. So my mom was already pretty active in the market. She wasn't a broker or anything. She was a widow with a set amount of capital. She wanted to stay at home with her kids, and she needed to grow that money. And so that was where she was at. And so the IBM shares, I learned early on how to play covered calls, things like that. So mostly an income strategy. So I didn't really need a lot in the beginning. But to your point, once I got to my senior year in high school, I really got into the markets. And by the time I was in college, I was so into the markets, I was actually almost flunking out of college because my GPA wasn't even a whole number. I didn't go to class. I sat in my dorm room or in the computer lab trading or figuring out charts and so forth. So my first account, and the reason I'm giving you a little bit of the history, this is in the late 80s, early 90s. So we're talking 88, 89, 1990. The margin required to trade commodities was far lower than it is now. I could trade corn for $400. I could trade coffee, coffee was expensive. I could trade cocoa or sugar for under $700. So it was a lot easier. We're talking a lot of years ago. It was a lot easier to start off as a commodity futures trader, and I played also options in stocks. So you didn't need a lot. I think my very first account was $1,200 or $1,700. And then when I really started, and then in college, I had a business on the side. By then it was about $55,000, maybe $6,000 when I first started. But please know, see, it would be very, very misleading if I said $5,000 or $6,000. You need the context of the year because things were cheaper. Although I will say this, commissions were bonkers back then. My round trips, my covered calls were somewhere in the 150 to 170 area, if I recall. And my first round trips in commodities trading, not day trading, overnight swing trading, were $75 or $45 round trip. I mean, they were ridiculously expensive. So as nice as the initial margin requirements were low, right? The commissions were at it. Brokers used to charge arm and a leg. And some of you probably remember those kinds of commissions. No direct access order execution, no level 2, heck, no depth of market, very little transparency. You picked up the phone to get quotes. You picked up the phone to put in an order, but it was very inexpensive back then to start. I would say now, I would tell anybody, unless they're trading penny stocks, and I don't do that, nor do I really recommend it. But unless you're going to play cash account options, I would not start with really less than $3,000. $3,000 for cash account trading stock and ETF options is doable, but some trades are just not going to be affordable. If a trader is coming to me with a very low, small account, what I usually say is save that money, just keep adding to your grub stake and come back when you have a little bit more, and then consume all the free content in the interim where you can educate yourself and learn and educate yourself, and then give yourself a fighting chance. We tell businesses not to start undercapitalized. I tell traders the same way. You're starting a business. please do not start undercapitalized. So there's a lot of traders that come to me and they'll say, Rock, I've got $1,200. And I say, look, I'm going to talk to you the way I would talk to a family member. Go back, save that money, add to it, and come back when it's a little bit more and give yourself a fighting chance. And in the interim, you got the internet. Come watch Charts and Coffee. Come watch the Raghee Report on Sundays. Watch all the free content that's on the internet. Go practice on a demo account. That doesn't have to be idle time. This could be the off season where you're training, putting in the work, going to the gym, putting in the reps. So when you've got the capital where you need it to be, now you're ready. Now you're really ready. So I hope that helps. And maybe kind of reading in between the lines there, Darius. That's the way I look at it. So I didn't start undercapitalized in a way that I was risking a lot of my capital because I just didn't have the initial margin issues as much. And I hope, and corn and beans and so forth, things that, unless you were trading around USDA crop reports, which I didn't, you really weren't looking at a ton of volatility. So I hope that gives you some transparency. Hey there, which indicator am I using that has the Momo and the trend boxes? I'm new to the service. If you're, and I don't know which room you're in, see, in the options room, futures room, of course, my sector secrets mastery, and I think even the day trading room, regardless of which service you're with, here at Simpler, I have a free layout in the room drive called Raghee's 3-panel tops. And we call it the trade flags. I think it's called the trade flag, JT trade flags. And it's built into the layout that I give members here at Simpler. Now, my sector secrets folks, you all get the sort of hot rodded version of this, which is the multi-trend down here. That's premium. And then the free version is that one right there. Okay. Holy cow. Is it already? Oh gosh, it's almost 9:30. You know what? Let me take a few more questions and we'll call it a morning. All right. So I hope that helps. See, hi, Raghee. Do you not consider the hourly chart? No, I don't. The first one is the 30-minute. No, I don't. No, and not that there's anything wrong with it, but the best thing that I can always share is what I actually look at and what I actually do. And I think that's my job as a mentor or coach. This is really what I do. This is really what I'm looking at. So no, I really don't. Not that there's anything wrong with it. I just find that if I'm going to day trade, looking at the 5-minute, occasionally the 2 for a little bit of fine tuning is helpful. When I'm swing trading, I'll look at the daily. And when I'm building a position in my portfolio, position trading, I'm going to look at the weekly. And my life is much more clear and compartmentalized because I know 5-minute means day trading, daily time frame means swing trading, weekly time frame means my portfolio. On Friday, after 2.5 hours, the market started to dump. A lot of players must have known and prepared to dump ahead of time, right? I think there's this belief that there is a group of traders that know exactly where everything's going to be and how the markets are going to move. I've never believed that. I don't believe there's this sort of this sinister force that knows where markets are going to go and so forth. What really happens, based on my experience, and I worked with brokers. I used to work with a Forex broker. I had a lot of understanding of transparency when I worked with them. They can see order flow, right? But there's not this agreed upon time where suddenly the powers that be know now's the time to dump because now is when we can burn the retail. I believe it's just either volume levels are hit, preset levels, conditional orders are hit, things of that nature. I don't look at the market through sort of a sinister prism. I don't believe a lot of, who are the players, right? We're talking institutions and banks. Remember, they see order flow. Their job is actually, most of their job, I think people think that institutions and banks are speculating somewhat, but mostly they're filling orders, right? Mostly what they're doing is they've got an order. If they're a prime brokerage or whatever, they've got a big order, hundreds of thousands, if not millions of shares. And they're filling this for their client. They're going to use volume weighted average price because when you've got that kind of size, you want to sort of bury it as much as you can in volume. So it's not obvious what your position is. It's not obvious what it is you're trying to do. Because look, if we know that there's a huge buy order out there, what's going to happen? We're going to try to front run that buy order and take advantage of something that we think is inevitably going to happen. So what I think really is what's happening, my 2 cents, is that much like the specialists on the floor of the New York Stock Exchange back in the day, they can see both sides of the orders. They can see all the buyers and the sides. They can see the sellers and the sides. So they have that level of transparency. So they've got a pretty good idea where deals could happen. A lot of times, movement, I have a saying, momentum begets more momentum. Sometimes when a market gets going, it just attracts more attention in that direction. So I don't know if that answered your question, but no, I don't believe that after 2.5 hours, some sort of alarm went off at a hedge fund or an institution or a bank, and now they knew they were going to sell. Maybe it was a price level, maybe it was volume levels, but I don't think that it's this premeditated thing necessarily. It's just a strategy that's now valid, and the orders start to hit the market, and then momentum begets more momentum. That's the way that I look at it. That's the way that I look at it. So I hope that makes sense. And look, gang, you don't have to agree with me, but I will tell you this, and this is what's worked for me. If I wake up every morning, and I've been waking up and doing this every morning since my teens, turned 51 just last week, so it's been a lot of mornings. If I wake up and I think I've got this adversarial, they're out to get me vibe about the market, it's going to make you miserable. You meet those kind of traders that do that. They're sort of ornery and sort of miserable, and everyone's out to get everyone. I think the market is an order matching machine. And I love your question, by the way. It's an order matching machine. The market moves in the direction of the most orders. And we can see these orders if they're conditional, stops and limits. And most market participants get paid when they fill orders. That's their job. So the market's going to move in the direction of the most orders. And if we just treat the market more as if we're a surfer, surfing the ocean, you think the ocean cares that there's 10, 20, 100 surfers on a wave? No, the waves are coming in and doing what they're going to do anyway. So I just figure if I can position myself as a surfer and take advantage of the wave, it's a lot more on me to recognize the environment rather than having to feel like someone's trading against me and someone's out to get me. And I just don't believe that to be true. So I don't know if that's what some traders believe, but I don't really believe that to be true. The market is an order filling machine, and it doesn't care who's in the way, and it's looking at where the size is. So then you got to ask yourself, am I using size? Am I using this big wave to surf? Right? Or am I on the wrong end of the wave and it's going to crash on my head? The ocean doesn't care. That's the way I look at it. I don't know to whom that's going to resonate, but I sure hope it does, because otherwise trading becomes really miserable and exhausting rather than sort of this fun, cerebral game that we play that, oh yeah, if we get pretty good at it and disciplined, we can pull money out of thin air, which is still a very cool feeling. All right, gang. I hope that was somewhat helpful. I hope that makes sense. And I will see you all tomorrow, same time, same station, Charts and Coffee. Caffeinate and dominate, gang. I'm going to go take a look at some charts here this morning and then go enjoy some time with my family. All right. Be good to each other, gang. Thank you for spending some time with me this morning.